Okay, today I'm responding to Juggy's very kind suggestion for the topic, and please, anyone who has a topic, let me know, because I like to work. Okay, first report asks, which South American countries win and lose from the Hormuz conflict and why? Report 2 answers the follow-on question nobody was expecting. What does China's sulphuric acid ban have to do with Friar's silver leap? The connection is not obvious. That is exactly why it matters. The best trades come from insights the market has not yet embedded into the price. Today we are going to build the latticework from the Hormuz all the way to Friar's silver options. The core framework. Same shock, opposite outcomes. The IMF's April 2026 World Economic Outlook makes this explicit. The same geopolitical shock produces a terms of trade windfall for some economies and a balance of payments crisis for others. This is not opinion, it's the mechanics of international trade. Think of it as a price factor. Energy prices rising is unambiguously bad for import-dependent economies. For export-dependent economies, it is unambiguously good, provided they are not also exposed on the import side. This is a critical nuance South America requires. You cannot simply say South America benefits from higher commodity prices. You must ask, which side of the commodity ledger does each country sit on? So the left box, Chile, Colombia, Peru are net commodity exporters with low fertilizer import dependency. The Hormuz shock raises their export revenues and does not materially hurt their import costs. These are terms of trade winners. Right hand box, Brazil and Argentina are also commodity exporters, but they are simultaneously massive fertilizer importers. The same shock that raises their export prices also raises their agricultural import costs. This creates the paradox we explore in the next slide. The fertilizer paradox. The C variable, what the market is missing. This is the slide where we introduce what Friar calls the C variable. The physical supply mechanism that markets overlook while pricing the obvious first-order effect. The consensus trade on Brazil is simple. High soy and iron ore prices are good for EWZ, which is the ETF that covers Brazil. That is a first-order obvious effect. What the market is not pricing is the input side, destruction happening simultaneously. Brazil imports more than 80% of its fertilizers. Of that, 41% of its urea alone passes through the Strait of Hormuz. The strait being effectively closed now, North Dakota State University has modelled the outcome. If closed through July, urea imports fall 18.7% over the next 12 months. If closed through year-end, the fall is 27.3%. Local urea prices in Brazil already jumped 35% when the conflict began, and less than 30% of the farmers had bought fertilizer for the next crop season. The purchasing window is open now. This is not a future problem, it's a present crisis. The second order effect is Brazil and Argentina together produces 66% of the world's soybeans and 39% of maize. If they reduce fertilizer application or shift to lower yield crops, global grain supply tightens in 9 to 12 months' time from now. That feeds directly back into our CF, NTR and MOS fertiliser positions, as well as the DBA ETF, which is already on the watch list. A doctrine note: EWZ is flagged as a bear spread candidate, but only on confirmation from the spreadsheet algorithm and Q3 planting data. We don't want to trade until we have that. A pure terms of trade winner with one caveat: the copper lithium structural bull. Chile is the cleanest trade in this entire framework. It produces roughly 1/4 of the world's copper. It sits on the lithium triangle. It has no meaningful fertilizer import exposure comparable to Brazil. The ECH ETF, which covers Chile, returned 70.3% in 2025. It has outperformed the iShares MSCI Emerging Markets Index by 14.7 percentage points recently. The macro conditions that drove that performance are now intensifying. However, and this is a crucial doctrine point, the entire decade of price appreciation in ECH came in the last 18 months. 8 years of going nowhere and then an explosion. That is a momentum trade with a structural backdrop. It is not a mean reversion value play. You are buying into a trend, not a discount. There is also a new complexity introduced by Report 2, the sulphuric acid story, which we will cover shortly. The acid shortage directly threatens the 20% of Chilean copper output that comes from acid-dependent SXEW heap leach operations. This introduces an earnings quality caveat on ECH that has not been present 3 weeks ago. The net effect is still likely positive if copper prices rise faster than acid-driven cost increases. ECH still works, but this is precisely why the spreadsheet algorithm must confirm the signal before we commit capital. Okay, country matrix, Hormuz net effect scorecard, framework before tickers. This matrix is the distillation of everything in report 1. Before we even look at a chart or an options chain, we establish the fundamental verdict from first principles. This is Friar touch doctrine in practice. Fundamentals first. Narrow the universe, narrow the number of tickers you're focusing on. Only then go to the spreadsheet. Chile, Colombia and Peru are tier 1 bulls. Strong terms of trade benefit, low fertilizer vulnerability. ECH, GXG and EPU are the ticker expressions. Peru via EPU is worth flagging as potentially undercovered. It is a copper, gold and silver exporter with similar fundamentals profile to Chile, but far less institutional attention. That combination, strong fundamentals backdrop with lower coverage, is where mispricing often happens. Brazil via EWZ is the bear watch candidate, not a short today, a patient watch. We need Q3 planting data to confirm that the fertilizer disruption is flowing through to actual crop decisions before we structure a spread, before we go to the spreadsheet. Colombia via GXG has a strong fundamental story as an energy exporter, but the options chain is very thin. So we always check liquidity before structuring. A great thesis with no liquid expression is dead end. Argentina has no clean US listed options vehicle worth considering given peso volatility and political risk. Moving into report 2, the sulphuric acid choke point, the hidden valve in global supply chains. Sulphuric acid is what Sun Sirs commodity data group called a hidden valve in global supply chains. It is a foundational industrial chemical with over 260 million metric tons produced annually, and roughly 60% of it feeds fertilizer production, with the remainder underpinning copper mining, nickel extraction, uranium leaching, and semiconductor manufacturing. It is not a headline commodity. It does not have a futures contract that CNBC discusses. That is precisely why the market has not priced the supply shock properly. The quote on the slide captures the thesis perfectly. What looks like chemical news is actually the Hormuz sulphuric acid fertilizer copper mine transmission chain being tightened simultaneously, two independent events converging on the same critical input. This is exactly the kind of second and third order causation chain that Friar doctrine is designed to find, focusing on the fundamentals, digging in to the fundamentals. The market prices what it sees. Friar prices what it's caused by. Whoops. Double choke point. Two independent events, one critical input. This slide shows the transmission mechanism in detail. The mechanism tells us how durable the disruption is. Step 1, the Hormuz closure, effective February 2026, blocks sulfur exports from the Middle East. The Middle East accounts for roughly 1/3 of global sulfur production and approximately 50% of seaborne sulfur trade. Sulfur is the primary feedstock for sulphuric acid. And remember that the Hormuz Strait remains closed. Step 2, Chinese acid producers, facing constrained feedstock supply, simultaneously receive instructions from the government to halt acid exports from May 2026. China accounts for over 40% of global sulphuric acid production. They are prioritizing domestic agricultural demand during peak spring planting season. A rational state decision, but devastating for overseas buyers. China couldn't give a toss. The data tells the story clearly. Chinese exports to Chile went from 151,268 metric tons in March 2025 to 31,870 in February 2026 to 0 in March 2026. That is not a gradual adjustment, it is a structural removal. The CFR Medialones benchmark, the standard Chilean reference price, doubled in under 7 weeks. A single week price spike of 26.7% followed the China announcement. Russia has also extended its sulfur export ban through at least till June 2026, removing another potential offset route. There is no viable chemical substitute for sulphuric acid in the SXEW operations. This is the hard physical constraint, not a cost problem that can be managed by paying more. Chilean copper. Who gets hurt? Who gets insulated? Intra-sector differentiation matters. Not all Chilean copper producers are equally exposed. This is an important nuance for anyone considering ECH or individual copper mining names. Codelco, the state-owned giant, is actually long on sulphuric acid. It has its own acid production from its smelting operations and sells surplus to other Chilean operators. In a shortage, Codelco's acid position becomes a commercial advantage. This is what Robert Friedland at Ivanhoe described in a different context. One company's reagent problem is another company's pricing power. Antofagasta is at the other end of the spectrum, identified by CSCO weak industry participants as the shortest on supply. Antofagasta is a major SXEW operator with significant spot market procurement exposure. The smaller SXEW operators are in the most critical position. Wood Mackenzie confirmed Chile is short of acid. Some operators had less than 30 days of supply on hand in April. The key number is the 20% figure. Approximately 20% of Chile's refined copper output comes from the acid-dependent SXSW operations. That is roughly 1.1 million metric tons of annual production at risk. Goldman Sachs estimates that extended Hormuz disruption could reduce the Democratic Republic of Congo copper production by 125,000 tons in 2026 alone. The Chile exposure is of similar or greater magnitude. For ECH as a trade, the major SXEW operators are a subset of ECH's holdings. The fund's financial exposure at 26.6% and materials at 17.2% mean the copper direct hit is partially buffered, but it is not zero and it is not priced in. The silver connection, third order effect. This is thesis reinforcement, not a new thesis. This slide connects everything back to our existing position in SLV. The connection that nobody in the silver market was discussing 6 weeks ago. Approximately 70% of newly mined silver is a byproduct of base metal mining, with copper alone accounting for about 27%. Silver does not come out of dedicated silver mines in most cases. It rides along with the base metal. When copper production is constrained by acid shortage, silver output falls with it. This is not a theoretical mechanism, it is a direct proportional relationship. Layer this onto the existing silver supply picture. The market has been in structural deficit for 6 consecutive years. The cumulative shortfall since 2021 exceeds 800 million ounces, equivalent to the entire year of global mine supply. Demand is forecast to outstrip supply for the 6th straight year in 2026, driven by a 20% increase in physical investment offtake. COMEX, London and Shanghai vault inventories are all declining. When the market needs to draw down above ground stocks, it typically requires higher prices to incentivize holders to release the material. That is the price discovery mechanism that should be driving SLV higher. However, it is very difficult for independent traders to have the same influence on COMEX to manipulate the markets as Jane Street and JP Morgan have. The SLV January 2027 leap was positioned around the original Hormuz divergence model thesis. Hormuz disruption tightens silver supply into a structural deficit. The acid ban now adds a second independent supply destruction vector. The thesis has not changed, it has been reinforced. When the thesis gets additional confirmation from an unexpected angle, it's not a reason to exit, it's a reason to continue to be patient. Okay, we continue to wait. Candidate tickers and the doctrine framework. 3-step process, non-negotiable. This slide is the practical output of both reports. Step 1 is fundamentals. We have done that work today. We have narrowed the universe to Chile, ECH and COPX, Peru, EPU, and SLV, Silver ETF on the bull side, Brazil, EWZ on bear side watch. Step 2, the spreadsheet algorithm. Every candidate goes through the full stack. No signal, no trade. We are waiting for trades that sparkle. Step 3, the live chain, actual delta, bid-ask spread, and midpoint. On ECH specifically, the new complexity from the acid shortage means the signal must be particularly clean before we enter. The fundamental picture is more nuanced than it was 3 weeks ago. We need the algorithm to confirm, not just the macro. EPU, this is the highest upside, potentially lowest awareness expression. Copper, gold, silver exposure in a single country ETF. Few institutional eyes on it. Worth running through the spreadsheet as a priority, which I'll do. On EWZ, we do not short or buy puts on anticipation. We'll wait for third quarter Brazilian planting data to confirm fertilizer disruption is translating into acreage reduction before structuring a bear spread. On SLV, the existing leap is currently marked down 43%. The reinforced thesis from today's analysis supports patience. Friar is happy to be patient with silver. The manipulation will come to an end. Facts that don't hang together on a theory are not usable. They are just noise. Today we built a framework across 3 orders of causation. The first order, Hormuz closes, oil surges, though it's not at the moment through manipulation. The market price this on day 1. There is no alpha in the first order effect. Second order effect, supply chain disruption triggers fertilizer squeeze and copper acid shortage. The market is beginning to price this. We are in the early stages of second order pricing. Third order, Brazilian agriculture margins are compressed. Chilean copper SXEW output is reduced. Silver byproduct production falls into a 6-year structural deficit market. The market has not priced this. This is where the alpha lives. The SLV leap, positioned at the intersection of the second and third order effects. The thesis is intact. The new supply destruction vector from the acid ban is confirmation, not contradiction. To close, Paul Tudor Jones said the best trades are the ones in which you have all factors in your favour. We now have Hormuz supply destruction, Chinese export restrictions and the Russian restrictions, a 6-year structural silver deficit, declining vault inventories, rising physical investment demand, and an acid-driven copper output constraint, all pointing to the same direction for silver. Waiting for this kind of alignment requires patience and discipline. That's what Friar's doctrine is built on. It's not easy to keep the patience and discipline. And really, if you have questions, and importantly, any other topics you would like me to cover, it would be my pleasure. It gives me something to do. Thanks.